Cash on the sidelines. Last week, there was an article in the Wall Street Journal implying that there are trillions of dollars sitting on the sidelines ready to pour into the stock market. Now, the article focused on money market funds, but some would argue that you should consider those funds, checking in cash, savings, short-term CDs, all of that is a big pool of cash that could find its way into the stock market. Now, if that's the case, we're talking $20 trillion. Yeah, I know it's unlikely $20 trillion will come pouring into the market. In fact, some experts actually say there's no money on the sidelines because such talk falls into the category of fallacy of composition. In other words, money in those instruments are there for a reason, and most people wouldn't sell them even for higher stock market returns. Plus, they say every buyer is matched by a seller, so the cash that goes into buying a stock would then go to the seller who just sold that position. Now, these theories are intriguing. However, there is a ton of cash on the sidelines. In fact, global money managers handling $750 billion had cash as their largest position, also followed by defensive instruments like REITs and consumer staple positions. Now, I think the sideline money effect has already begun to find its way into the stock market. Focusing initially on these big 2019 winners, it's a scheme. We all know it by now. It's called window dressing. If the upside momentum continues, there's going to be a flood of money pouring into these markets off the sideline. And, folks, that is no fallacy. With more on this, I want to bring in Capital Wave strategist Shah Gilani. Shah, you know, we talk about this all the time. There's a bunch of money sitting on the sidelines, and at some point, it's got to go to work, particularly professional money managers.
Yeah, they are way behind the curve here, Charles. The professional money managers have been on the sidelines with too much cash for too long. As rates are what they are now, they're going to continue to be lower for longer. These money managers are continuing to be behind the curve. Now, we're seeing that increasingly now. I agree with you. I think we started to see money come in off the sidelines in the last couple of weeks. I think we're going to increasingly see that through the fourth quarter, all the way into the new year. These money managers are so far behind the benchmarks that they're measured against that they're going to have to start buying. They're going to buy the momentum stocks, the Apples, the Microsoft, all the stocks that have already done well, made new highs. They're going to continue to plow into those, and they're going to start buying value stocks, especially good dividend-yielding stocks. So the market's got, I think, another perhaps 10% to go higher based on this cash potentially coming in. And there's a lot of it. I think there's at least $1.5 trillion ready to come in. Will it come in all at once? No, I think it's going to come in over the next year to two, but I think it's going to come in regularly.
What do you say, though, to the experts or these people say that this whole kind of conversation is ridiculous because there's no such thing as sideline cash?
I think that in itself is an absolute fallacy. Of course there's sideline cash. You look over at the market since July, it's been pretty much a sideways market until we broke out and made new highs across all the major benchmarks. A lot of money managers were taking money off the table then. They were taking money out of stocks that they had nice profits on as markets looked like they were maybe going to slip. As we're going in a sideways pattern, they thought, well, if we break the support levels below, it's time to take some cash out. So there's plenty of cash just from that alone. Let's not forget, this has been the most hated, mistrusted bull market in history. This is since 2009. Nothing has changed. It's hated even more. It's mistrusted even more. And that means it's going to go a lot higher.
We've seen bond yields start to spurt higher. The 10-year 193. Is there a point, where now bond yields start to become competitive again? You remember that, bond yields are so high that they may start to be competitive with respect to equities. Are we there yet?
No, I don't think we're anywhere near there yet, Charles, because the yields aren't certainly high enough. Dividend-yielding stocks and the dividend yield on the S&P 500 is high enough where investors recognize they're better off in equities because they have upside appreciation for equities. People are more afraid of being in bonds in here and there being some correction in the bond market, right. Yields going higher, prices going down, then getting hit. The flow has been into stocks, and I think it'll continue to be that way.
Shah, thank you always. And again, always jealous you're down in Miami. We appreciate it. Folks, the Dow's up 10 points. As I hand it over to Liz Clayman.